What's your take on commodities?
So I'm a commodity bull, and here, just in my own personal experience, each time Chinese growth has reaccelerated, commodities have done fine. Now,
Mhm.
today Chinese growth is reaccelerating. After 5, 6 years of brutal consolidation, of a collapsing real estate market, of all of which we can discuss if you want, but um, you're now seeing sequential improvements on pretty much every single matrix in China. And so the Chinese economy is doing better. So number one. Number two, we are starting to see serious fiscal stimulus in Europe. Um, Fiscal stimulus that is going into infrastructure spending, of course, into defense, and into essentially rebuilding Europe's energy grid,
Mhm.
which is very much needed. So you have, yes, growth is going to be slowing in the United States, but remember that for the past few years, the U.S. was the only game in town. It was like, oh,
Yeah.
nowhere else is growing. Europe is an outdoor museum. China is dying away and is not going to be anything. So, uh, there's a lot more people in Europe than there are in the United States, and there's of course a whole lot more people in China than there are in the
I've
United
been looking
States.
forward to this for ages to get a chance to talk with Louis-Vincent Gave, co-founder, CEO of Gavcal Research, been around for decades, acknowledged experts on China, Asia, and now the rest of the world called on. But here's the thing, talk about great timing for what's going on, but he's also the author of a bestseller called Avoiding the Punch, Investing in Uncertain Times. Well, I guess so. Louis, thanks for finding time for us.
Mike, thanks a lot for having me. It's a real pleasure to be here. Thanks. Yeah, real honor. Thank you very much for having me.
Well, as I say, there's so many subjects to get to. I mean, I don't, I just feel it's one of those times I'm bombarded with things I have to keep aware of, and because it is global. You guys have been doing, of course, capital flow style research, for decades, and I think I've always thought that was the key to understanding why things are moving, why prices go up, why they go down, et cetera. So I want to start with what's top of mind for Canadians, obviously, and that's the tariffs with the U.S. It's a broader story, and that's why, again, your perspective is important, but it's tariffs with China, where you guys are the acknowledged experts there. It's threatened tariffs with Europe. So give me a quick take on what they're doing. I mean, isn't that the question you're getting asked around the world? What the heck is the U.S. doing here?
Um, we do get that question a lot, and I wish I had the answer.
Mhm.
The answer is I don't, because it's a constantly moving goalpost. I think if we take a step back, the big question mark is whether tariffs are a tool or whether they're the end goal by
Mhm.
themselves. And I think, as Trump was forming his administration, the general perception of most market participants was they're a tool.
Mhm.
Trump uses tariffs to say get things done in Mexico, i.e., crack down on the fentanyl labs, and get things done in Canada, crack down on the border. Um, and the guys who really argued hard for tariffs as an end goal, people like Robert Lighthizer, who said, look, we need to have 100% tariffs because that's the only way we're going to reindustrialize the US. When Trump was forming his administration, these guys were more marginalized. So it looked like we are heading towards tariffs as a tool. And to be honest, I think, what are we in now? Like 10 weeks in or whatever it is. And so far, it has seemed like it's tariffs as a tool. It's like, you know, Colombia, I'm going to put tariffs on you unless you take your illegals back. And
Mhm.
Mexico and Canada, it's so far the threat remains do this or else.
Yeah.
And now the challenge, I think, for investors is that there seems to always be things to be upset about. And tariffs get used as this magic wand where it's like, okay, if you don't do this, I'm going to tariff you. Um,
Mhm.
and this gets old. This gets old. Like you can use it every now and then, but if you use it every week, first of all, it starts working less, and secondly, it also starts to have an economic impact because what you're seeing now, I think, is a lot of businesses, a lot of consumers, a lot of entrepreneurs holding back on investment, holding back on consumption because of this uncertainty. And here, I always tend to believe that uncertainty is the biggest killer of growth. And, we lived through it in China for 5 or 6 years, massive policy uncertainty. And then entrepreneurs just sit on their hands. Like most business people, most entrepreneurs, of course, nobody likes taxes. Of course, nobody likes regulations. And you always want less regulation and less taxes, but you can live with it as long as you have predictability.
Yeah.
Most entrepreneurs want to know, okay, these are the rules of the game. Then I know what the rules are, and I decide to make an investment or not, and I go for it. Um, the uncertain nature of the trade policy, I think, is starting to be a real drag on growth for everybody, for Canada, for the U.S., for Mexico, for China. Nobody dares invest when you don't know what tomorrow's made of.
It's interesting also, of course, the stock market, Ala, what you're saying, has not been happy with the tariff approach. I just find it interesting because President Trump used to point to the stock market as validation for he was doing the right stuff. Well, I think we've given away everything we gained since its election. So I just found it interesting. They've shifted into looking at the bond market.
Yeah, you're absolutely right. And I think that's a super, super important shift. To your point, Scott Bessent, JD Vance, Elon Musk, President Trump himself talk about the bond market all the time. They no longer talk about stocks. Now, I think this reflects a super important reality that most people have overlooked. And this reality is that if you go back to 2020, so 5 years ago when COVID unleashed, not only did the government go on a hell of a borrowing binge because, it had to, but corporates in the second half of 2020 and the first half of 21 borrowed more money than they ever had because if you remember, bond yields absolutely collapsed. So if you were the CFO of a business, it would have been criminal for you not to issue bonds. If the market's going to give you money at 1.5%, you have to take it. And they all did. And they basically all used that money to buy back their shares. Now, fast forward, most of the corporate debt is issued on a 5-year tenure. So fast forward 5 years. And in the second half of this year, first half of next year, you have massive debt rollovers coming in. And that is, I think, why they're focusing so hard on the bond market, because they know that if they don't get the bond yield down, what you end up with in the second half of this year, first half of next year, is corporates that suddenly have to pay a lot more out on interest. Now, this doesn't mean they go bust, but it probably means that you see a lot less capex, you see a lot less employment, just overall tightening of belts. And that would happen just in time to unleash a big slowdown just before the midterm.
Yeah.
So that'd be very suboptimal. So I think the plan is pretty obvious to me: is get the bond yield down as much as you can right now, get the rollover done. Once the big rollover is done, basically by the summer of next year, summer of 26, then you do the tax cuts that you've kind of promised. And at that point, it doesn't really matter as much. And so you basically re-goose your economy next summer. But for now, the focus is, you're absolutely right. It's not let's get stock markets higher. It's let's get bond yields down. Because if we don't get bond yields down, we could hit a big air pocket in the coming months.
One thing you said there that I think is really noteworthy is that what did they do with the money they borrowed in the year 2020, for example? Well, they bought back stock. That's not a productive use of it. They didn't expand plant and equipment that could facilitate, paying for a lot of this stuff. I mean, obviously that might be a benefit for the shareholders, but that just says they've come out, they owe all this money, but they've got no extra productive capacity from it.
Absolutely not. No, look, show me the incentives. I'll tell you the outcome. If you're a management CEO, CFO of a listed company, and you have access to free credit and you can goose up your stock options, of course you're going to do it. And lo and behold, that's exactly what they did. And in that respect, I think that's what separates the U.S. perhaps from other major markets, whether Canada, whether Europe, whether China or others, is the size and the depth of the corporate bond market. European companies didn't really have the option. When interest rates went down to zero in Europe or to zero in Canada, corporates didn't have as much the option of let's issue a ton of debt on the corporate debt market and buy back shares. That was never, some did. If you were at the very pinnacle of the corporate pyramid, like an LVMH in France did that, and a L'Oréal in France did that. If you were like a massive global company, you could. But if you were your typical small mid-cap company, you didn't have that option in the way that you did in the United States. So the rollover in the US is disproportionately large relative to anywhere else in the world. And yeah, I think that's a big Damocles sword today hanging over the US market. And that's why they are so focused, they being the US administration, is today so focused on getting bond yields down.
Uh, I'm skipping around a little bit because I want to get to it all here. One of the things on Money Talks, we've been very bullish on now, not as a trader, but as an investor, out of Canadian dollars into US dollars. Well, then Trump comes in and I said, it worries me because that is clearly his goal is to get a lower US dollar. And I really wanted to make sure people had that on their radar because have we been saying something different for about 9 years or whatever it was, 10 years. And I think that looks like that's in play too. I mean, they look like they've had some success getting that US dollar lower. I know it's short term, but looking at the last month or so.
Yeah, absolutely. Look, I think when you listen through all the noise, and it's easy to
Mhm.
get stuck in the noise, right? But when you take a step back and think, okay, what is the Trump administration really trying to achieve economically? They want lower yields for the reasons we just discussed. They
Yeah.
want a lower dollar
Mhm.
for a number of reasons, but not least of which is that without a lower dollar, you're not going to get to reindustrialize the United States. And they want a lower energy price. And if, throwing Ukraine under the bus to get a deal done with Russia, where Russia starts pumping more energy, is the cost, then so be it. Those are the three main goals of the Trump administration. Now, of course, it doesn't mean it gets to achieve these goals, but by and large, in my experience, when you have a government that is committed to weakening its currency, it usually achieves its goal. And it's hard to strengthen your currency, but to weaken it is really not that hard. And so, yeah, I think we've seen the highs in the US. By the way, if they are successful in driving the bond yield down, that will drive by de facto
Yeah.
the US dollar down. So, no, look, I think today the Canadian dollar is very cheap. Now, this isn't to say that Canada doesn't have a lot of issues. You still have the hangover of a real estate bubble to deal with. Um, you still have a very rapidly changing growth model where for years most of your growth just came from immigration, and you've now decided as a country, okay, that's gone too far. We need to digest what we've taken in. So there's still question marks surrounding Canadian growth, but by and large, I think a lot of these are now reflected in the price of the loonie.
Yes.
It's a very, very cheap currency.
Yeah, I'm going back to 1985 too, and when the Economist put the U.S. dollar on Superman on the cover, and I'm just remembering how fast that can change,
Yeah.
and it was really abrupt. But one of the things that happened was, big sell-offs in parts of the market too, because if I'm a foreign owner and they say, well, when I come back to exchange it into my own home currency, that's also going to be a problem. So I think it's just another level of uncertainty for the stock market.
Oh, no, look, absolutely. Look, the reality is the U.S. Runs massive twin deficits. So
Hmm.
for the U.S. dollar to be strong, you de facto need to import a ton of capital to just plug those two holes. And if suddenly there's a little bit of a doubt amongst foreigners that either the returns on capital aren't going to be as great as you'd expect, or worse yet, that the safety of capital might not be as great as you expect. Because there's one thing that nobody really commented on, but if you go back to, funnily enough, the very first country to be threatened with tariffs was Colombia. If you go back to the
Hmm.
very first day of the Trump administration, they loaded up a couple planes with illegal immigrants. They sent them down to Colombia, and the Colombian president said, "No, thank you. We're not lending those planes." And Trump tweeted, "If you don't take those planes, I'm going to financial sanction you and essentially seize the assets that Colombia has in the United States." And so I thought, wow, and of course Petro immediately folded, because nobody can afford to be kicked out of the dollar system. Nobody can afford to have their reserves confiscated like they did for Russia. But I thought that's a hell of a threat to make, because if I'm any other country, if I'm Saudi Arabia, if I'm Qatar, if I'm Kuwait, anybody, I'm thinking, well, hold on. So if I don't do what Trump tells me, he takes my stuff. Like, do I still want to be here? So, I think when you look at an investment, there's always two things, right? Um, there's the potential returns on capital, and then there's the return of capital.
Yes.
And I think one of the big lessons in recent years, the confiscation of Russian assets, the confiscation of the Russian oligarchs' assets, etc., is that maybe we can't take the return of capital as granted as we had in the past. Now, to be fair, I think the U.S. still has independent courts, independent justice system. And so if it came to that, you could go to the courts and seek and get redress. I still think the U.S. still has very strong property rights and rule of law and all these things. But, who wants to get stuck in the courts for 3 years, 4 years, 5 years? And these things are
Yeah.
costly. It's like a pain in the neck.
Well, let me go further with that too, because I would have thought that was a big impetus for people saying, I don't want to be in that system, so maybe I'll be in gold, or maybe it's been an impetus for Bitcoin. But that was, I thought, really significant, the confiscation of the assets. In Canada, we had our old smaller version when the government froze the bank accounts of perfectly law-abiding Canadians for supporting the truckers' convoy. But it's the same attitude, and people start getting real nervous about the safety of their, as you say, the return of their capital.
Absolutely. Look, the freezing of the convoys, incidentally, it was your finance minister who suggested that we should freeze all the Russian assets. It was her idea. It was Chrysler Freeland's idea. So she did it to the truckers, and right on the back of this, because if you remember, it sort of Ukraine happened right on the back of that. So two disasters in a row from her, and she's still going. Like the Energizer Bunny.
Yeah.
So who knows what she comes up with next? Leaving that aside, you're absolutely right that since this has happened, basically gold's been bid, Bitcoin's been bid, and yeah, it's we've moved from a world in which U.S. Treasuries were the default risk-free asset. They were the sort of core base of every portfolio, to suddenly, for a lot of people, maybe not people in Canada, maybe not people in the U.S., but definitely people in the Middle East or in Asia or elsewhere, rethinking, maybe U.S. Treasuries shouldn't be the core building block of my portfolio. And yes, maybe it should be gold bars.
We talked about the bond market, and here gold and precious metals. There's two more I've got to get to, and one is something that you had been writing about and really sensitized me personally to it. Is when China came out with DeepSeek, the artificial intelligence. It didn't immediately occur to me that ends the monopoly of the those participants in the Mag 7, and why the heck would I pay huge price earnings ratio if there's going to be that level of competition, especially coming from China? And you were the first I ever saw to write about that. And that, does that put a cap sort of on the US stock market? Because obviously those have been the driving force.
I think it does, to be honest. Look, one of my go-to lines is when China enters a room, profits walk out. And I think when China entered the AI room, it massively changes the equation on everything. Up until 10 minutes ago, I think that the market consensus relative artificial intelligence was that, number one, artificial intelligence would change the world and that it would generate massive cash flows going forward. But to get a seat at the AI table, you essentially had to put 50 billion of capex on the table every quarter, and this for the foreseeable future. And that in so doing, the likes of Microsoft and Facebook and others would be building massive moats. They were essentially buying themselves into a monopoly.
Right.
And in comes DeepSeek, that frankly creates an LLM that's better with two pieces of string and a piece of bubble gum. And now all of a sudden the narrative completely changes. And on the back of that, Baba releases its own AI, and so does ByteDance, and you get a bunch of other releases. And now all of a sudden we realize actually AI is going to be commoditized. There is not going to be any moat, and the the hundreds of billions of dollars that the supposedly smartest guys in the world just spent on capex probably needs to be written off to a big fat zero. And so, yeah, it completely changes the narrative. All of a sudden, you're like, okay, so why am I paying 50 times earnings for these guys? Now, I think when you look at the US, what's interesting in the US market is you have essentially 15 names. In our research, we've called them the Nifty 15. I know there's the Max 7, but it's not just them. There's a few other big names that are all trading at 40, 50 times earnings. Think of an Oracle or a Walmart or a Costco for that matter. I mean, these are big companies. You have essentially 15 companies that account for 45% of the market cap of the US that are all trading at very, very punchy valuations, but the rest of the market, not so much. And so I think DeepSeek has all of a sudden, made a big shift. And it's actually interesting because I think so far this year, the S&P is down, 2 or 3% for the year. I think the S&P equal weighted is up 3% for the year. And so it's basically, we're seeing the reverse of what we've seen in the past couple of years, where if you were in the Nifty 15, you were laughing, and if you held anything else, it was miserable. And now we're seeing the rotation back, and it's healthy. I think it's that's how markets work. Things get too crazy, too excited. You get a reality shock, and markets readjust, and I think that's what we're going through.
As I say, I don't want to let you go without also asking about commodities. And, if we're going to get slower level of growth, the tariffs contributing greatly to that. And I'm just wondering, what do you feel about the commodities? Because, the China story was always supposed to be the thing that propelled it if we went back 2 or 3 years. And that hasn't manifested, although, as you've written, it seems like it's coming out of that phase into a more positive growth phase. But still, what's your take on commodities?
So I'm a commodity bull. And here, just in my own personal experience, each time Chinese growth has reaccelerated, commodities have done fine. Now, today, Chinese growth is reaccelerating. After 5-6 years of brutal consolidation, of a collapsing real estate market, of all of which we can discuss if you want, but you're now seeing sequential improvements on pretty much every single matrix in China, and so the Chinese economy is doing better. So number one. Number two, we are starting to see serious fiscal stimulus in Europe. Fiscal stimulus that is going into infrastructure spending, of course, into defense, and into essentially rebuilding Europe's energy grid, which is very much needed. So you have, yes, growth is going to be slowing in the United States, but remember that for the past few years, the U.S. was the only game in town. It was like, nowhere else is growing. Everywhere, Europe is an outdoor museum. China is dying away and is not going to be anything. So, there's a lot more people in Europe than there are in the United States, and there's of course a whole lot more people in China than there are in the United States. So, one more thing: when China does better, and it is doing better, it has a big impact on the rest of Asia. Countries like Indonesia, like South Korea, like Thailand, Malaysia. All these economies are very much tied to what happens in China. So when China reaccelerates, these guys also reaccelerate. And when China reaccelerates, Latin America also tends to do better. So we're now in a phase of the world where yes, the US is slowing, but everywhere else is reaccelerating. And lo and behold, if you look at commodity prices, look at CRB index, etc., it's, in spite of energy prices have essentially done nothing for the past couple of years, the CRB index does seem to be, creeping higher. So yeah, no, I'm decently optimistic on commodities, with a big caveat is that the days where Chinese growth just goes pedal to the metal and absolutely gangbusters and has a huge impact on commodities, like what we're going to see in China isn't that. It's doing better, it's improving, but it's not going to be, let's pour as much concrete as the United States did in the 20th century over the course of 6 years, like they did a few years back. That's not going to happen again.
But China is a story, and that's why I'm going to put you on the spot and said we
Sure.
got to have a visit again in the near future about China. You've got office at your head office in Hong Kong, office in Beijing. You're there all the time. You speak Mandarin for goodness sakes, and
Not
I
not
just
as
think.
good as you'd think I should, given all the darn hours I put into this. I should be better than I am. And I've let it slip. I used to be better. I've let it slip badly. It's a constant struggle.
Yeah, but I mean, I don't think it's going out on a limb by saying China continues to be the story, as you said. They walk in the door, and you already know about the efficiency. Prices are going to go down. I mean, it's just their position globally. I think we do have a better appreciation for that. But as you just alluded to, I'm not sure how many people are aware that they're coming out of this phase that they've been in for a while, where things like the real estate decline has been the headline. There's going to be some new headlines coming out.
Absolutely. Look, I think the simplest way to think about China is that between roughly 1998 and 1999. So in 1998, China essentially decides we're stopping funding of all the inefficient SOEs because we want to
Mhm.
get in the WTO, and 25 million people lose their jobs. So they need to find a new driver of growth. So they liberalize real estate, and you got a 25-year real estate boom on the back of this. Essentially between 2000 and 2018, so actually 20-year real estate boom. Real estate was the driver of Chinese growth. Then in 2018, you get a huge shock to the Chinese economy when Donald Trump transforms what was then a trade war into a tech war. And he says
Mhm.
nobody's allowed to have access to high-end semiconductors in China. And the Chinese leadership freaked out. They thought, okay, if they can block semiconductors today, tomorrow it could be auto parts or industrial robots or petrochemical products or any number of things. So they said to the banks, look, we need to build resilience and independence on every single industrial vertical. So from now on, no more loans to real estate, only loans to industry. So from 2018 to 2024, you have a huge boom in Chinese industrial capacity. And this is when China starts to export cars and industrial robots and nuclear power plants and everything else. Then you get to 24, and now all of a sudden they realize actually we're dominating every industrial vertical. The ability of the US to cut us off from stuff is now gone. More importantly, and very importantly, now that we're at the very pinnacle of the tech pyramid and we can have our AI, etc., we can relax. Like we're fine now. And so you get to this year where all of a sudden it's all about boosting domestic consumption. And so you start to see money spent on, child allowances and, credit for kids for schools and whatever else. And so again, 1998 to 2018, all about real estate. 2018 to 2024, all about industrial capacity. And from now on, it's all about the consumer.
What a terrific summation that was, by the way, Louis.
Thank you.
Great stuff. And that's what you're known for, though. Co-founder, CEO of GavCal Research, offices, as I say, Hong Kong, Beijing, around the world. He travels around the world. And just so you know, we must visit again in the near future. But I really appreciate you finding time. I know your schedule of travel has been, let's say, challenging recently. So we appreciate you finding time for us on Money Talks.
Pleasure. Thanks a lot for having me.